Hey everybody, Margot here, and today I want to talk about risk management in trading and how it is rooted in our psychology. First, it's important to remember our brain's perception of risk. Now, obviously, there are some differences between trading, let's say Forex, and investing, like buying a stock or not knowing the outcome of your trade beforehand. However, the basics stay similar to everyday life. You have more control over what happens to you if you don't get run over by a car, say, than over the unknown event that may happen sooner or later. So why do we have different feelings about these two things? How can we use this information to improve risk awareness? Well, when you're trading, it can be really easy to lose sight of the big picture. You're focused on making money, and sure, that's great. But if you want to minimize your losses, then you must take certain steps. It is not going to save you from all losses, of course, and actually it is very likely that there will be many of them. However, your goal is to use strategies that will help you prevent continuous losses so you won't blow up your account. Stop loss orders are critical for controlling risk, and I would recommend using them with every trade you open. Because of stop loss and volatility in the markets, you can quickly blow your entire account over a simple mistake. And that's the thing, without a stop loss in place, your brain perceives the whole process as even more uncertainty. And let's be honest here, trading is uncertain and about probability of outcome. You never know for sure what's gonna happen next. Plus, at this point, trading can actually slowly transform into gambling because serious traders count everything in advance and they prepare themselves accordingly. Trading is 100% about preparation. The more accurate you can set stop loss, the better, as this allows you to exit every trade at the perfect time. New traders are usually not too worried about losing trades, so they hope that the market will reverse and their losses will be wiped out. However, hope has nothing to do with this trading strategy. You may hope that you won't hit that stop loss, but as the only hope, you should be realistic to understand the risk when it comes to your losses. And stop loss orders will make it easy not to make hope alone part of your strategy. The most important thing about trading is not how much money you make, but how little you lose. Now, there are many situations where a trader may have a winning trade, but they still lose money if they don't limit their risk appropriately by setting an appropriate stop loss point for each trade. In order for you to maximize your profits and minimize your losses, it's important to understand how to set proper stop loss points for each trade so that when things do go wrong on your position, you are quickly and automatically protected against further uncalculated losses. Now, a lot of traders tend to underestimate the importance of risk management, and they often get into trading without having a plan in place to minimize their losses and maximize their profits. However, this is not a good idea. You should always have a plan for every trade that you make. If you want to become successful at trading, then you need to know how much money you are willing to lose on each trade. When it comes to trading, you must know what you are doing, okay? You need to have a plan and a proper strategy, which you are going to follow. If every strategy has been back-tested and it has proven over time that it works for you, then you are on the right path to becoming a successful trader. But on the other hand, wandering through the markets while relying on high trade volumes and using no safety levers whatsoever will inevitably lead to failure. So learn how to exit losing trades early and often so that your account does not lose too much money when things go wrong in the market or when your strategy does not work as well as expected, and know when it's time for an adjustment or a change. And when it comes to risk management, remember that it is a very important aspect of trading. It's also one of the most difficult things to learn, as well as one of the most challenging to apply in practice. The risk management process starts with defining your goals, then identifying potential risks, and determining how much you're willing to lose on any given trade. Now, you'll need to decide what your maximum risk will be for any given trade. This will help to establish your stop loss point for each trade, which will protect you from losses if things don't go, according to plan. But you can find various EAs with automated position calculators and connect them to your accounts. Once your risk management plan is set up, it's time to start trading. And as you do, remember to always check yourself to know exactly what kind of trader you are and whether your personality type is suited for this kind of high-risk work or if it's not. It's not enough to just be good at trading. You also have to be good at managing your emotions and knowing when it's time to cut your losses and walk away from a trade. What has been your experience like with risk management as a trader? Go ahead and let me know in the comments below. I'd love to hear it. And please like and subscribe for more education and strategies just like this to help you to become a successful trader. All right, see you next time.